Okay, so, Benny, thanks for the invitation. It's, oh, I need to stick on here. Okay, that's right. Thanks for the invitation. It's great to be here, see many familiar faces, friends, and just to be in Israel again. It's, just great. I'm going to present a joint work with Alex Edmonds, LBS, Jan Schienemeyer from Indiana. The paper is called Social Responsible Divestment. So it's very much related to basically all the papers, not surprisingly, that have been presented. And actually that's inspiring, and we definitely need to actually look at those papers more carefully and hopefully better connect our own paper to that literature. Still not working.
זהו. להכניס אותו לפה.
אוקיי.
אז אנחנו להביא מצגת למחשב, ללינק.
That's okay. I hope so. Okay, so let's start with responsible investing. I think by now we all kind of understand the concept. And the idea is just to incorporate social and environmental aspect factors into investment decision. Now, by and large, we think of two different channels that we can use in order to incorporate those ESG elements. One is engagement, as Marco was telling us about, for example, through voting or through private discussion. And the focus of this paper is going to be on divestment, meaning simply selling companies that exert negative externalities from your portfolios. And within that class of strategies, I'm going to classify it into two. One is exclusion, one is tilting. Okay? And a spoiler, I'm going to argue tilting is what we should be doing. But let's start with exclusion, because I think most of us are more familiar with that strategy. So what is that? It's basically deciding we are not going to own any oil company in our portfolio, or we are going to divest completely from controversial weapons, tobacco, or whatever. Okay? And what is the logic behind it? It's very simple. Let's just starve those sectors from capital. Okay? We just want to kind of eventually kill those sectors in many ways. Now, this is actually getting a lot of attention. You can see here, this is just for asset managers that publicly announced or committed to divest from fossil fuels. And you can see the number of asset managers doing that is increasing over the years, and also the amount of assets that have been basically committed not to include any fossil fuels. So this is definitely happening, and why is it happening? Many reasons, but definitely from the perspective of asset managers, they're getting some pressure by asset owners, like the millennials or whatever, wanting them to have net zero portfolios. The Globe ratings, Marissa was talking about, is definitely looking at their average ESG ratings. So one way to improve your rating is just divest from those industries. And definitely as academics, when we evaluate those, the performance of many of those SRI funds, we look at their average rating. Now, that said, there is a question whether exclusion is effective, and theoretically, definitely, there have been already arguments and concerns out there that maybe this strategy is not that effective. Well, first of all, exclusion doesn't really deprive companies from capital. Why? Because if you sell, someone else has to buy. Okay, so we are not really preventing the company from capital, and even so, the exclusion doesn't affect the companies immediately. It might make it harder, more costly for them to raise capital in the future when they need to make investment, but it's not happening right now. And even so, if you think about some of those brown sectors, sometimes we think of those as basically being kind of, yesterday's industries. They might not have a lot of investment opportunities to begin with, so the cost of capital challenge is not that important. And also, they're actually quite cash rich, right? These oil companies, they're generating a lot of cash. Do they really need to rely as much on external capital markets? Perhaps not as much. That, and the evidence, as was also mentioned here before, the evidence, might suggest that exclusion is not as effective as you might think otherwise.
But I want the contrary, though.
What is that?
We say that is effective.
Yeah, well, you're talking about voice, and I'll talk about it because this is...
No.
Sorry, talking about exit. Yeah, talking about exit. And I'm talking here about exit, and I'm going to argue that, well, this is really about exclusion as opposed to tilting, which I think is consistent with that. But I'll get it. Okay, we can talk about it. But,
so our empirical evidence is very consistent with that.
Okay. Okay, so maybe we need to omit that section. Okay. But I'm going to argue that maybe it's simply not a channel up through the cost of capital. Maybe there are other things that managers or firms care about: the stock price. A low stock price would hurt the reputation, increase the risk of a takeover, termination, hurt the compensation, and so on. So this is where I want to go. I want to go toward tilting, talking about a different divestment strategy. So what is tilting? Is simply leaning away from brown sector, just holding the best ESG industry leader, the best in-class assets. Okay, so that's the idea. Let's basically not divest the entire sector, just hold the company that has the highest, perhaps, or the best ESG scores. What is the rationale behind it? Why that might be effective? Well, brown sectors, some sectors at least, can take corrective measures, corrective actions, in order to reduce the harm that they potentially cause, to reduce the negative externalities. Fossil fuels perhaps can, innovate in the green energy, renewable energy space. In fact, there is evidence that most of the renewable energy patents are coming from the fossil fuel, the oil sector. Okay, so if you're going to just hold the best asset in class, those companies which have taken those corrective measures, that's going to have an effect on the stock price of those companies. So you're basically rewarding managers for taking those actions and punishing those who are not going to take those corrective measures. Now, of course, what might be the problem with that from the perspective of the asset manager, it means that you're going to have some fossil fuel companies in your portfolios. So your ESG ratings are going to be somewhat lower. You might get some accusation for, greenwashings and might affect your inflows to the funds and so on and so forth. Okay, so the question is, well, which of those two strategies, the exclusions or tilting, is more effective? And that's what we do in this paper. We basically have a very simple model to study this trade-off between exclusion and tilting as responsible divestment strategies. So broadly, we're going to have a framework where we have brown companies that generate some externalities, like fossil fuel. We're going to have a profit-motivated managers, so managers they're not socially responsible, they are trying to maximize profit in some sense. We're going to have some primary, secondary market, and we're going to take a stance of investors that are just trying to minimize the externalities that the companies are exerting on society. I'm not saying, and there's a good discussion, debate, how do you even create such investors? Is it, whether the legal framework allow them to do so? But our point of view is, let's assume that that's the objective. What is the strategy that would actually get you the most effective? And we're going to focus on exclusion and tilting. Okay, so in a nutshell, what is the key insight? And then I'll dig a little bit deeper. We can compare these two strategies according to perhaps 2 or 3 dimensions. The first one is the cost of capital. Exclusion is going to have a negative effect or a positive effect on the cost of capital. You are just selling those companies, stock price will go down, it will be harder for them to raise capital. Tilting is going to do the opposite, perhaps. Okay, it's actually you're going to invest in those oil companies, meaning that the price is going to be higher and therefore cheaper for them to raise capital, which means that those companies will actually expand, will be able to actually grow, whereas in exclusion you're starving from capital. So that's kind of the standard argument. But the difference is that exclusion doesn't provide any incentives for managers to transition the companies. Why? Because fossil fuel companies know that the Harvard endowment, the University of Washington endowments, the Norwegian Sovereign Fund, they're going to divest them no matter what they do. Okay? So why bother to transitions? Whereas if you're going to tilt, then they know that, well, if they're going to be the best asset in class, maybe those endowments and institutional investors are going to hold. So there is a trade-off. These two strategies have different ways to affect the externalities. And we think there's a very nice analogy to something that we're more familiar with traditionally, which is contracting. In many ways, you can think about exclusion as well, what is the cheapest way to actually pay the manager? You can just give them flat salary. That will reduce or minimize the cost to the shareholders on one hand. On the other hand, provides no incentives whatsoever to take corrective measures. Tilting is more like, let's provide incentives to managers to take, maybe to invest in renewable energy, but that's going to be costly to the shareholders, right? You have to provide some skin in the game. You have to pay for performance. And that's exactly going to be the trade-off between exclusion and tilting. Okay, so that's where I'm going. So what is the main result? Just a very quick preview. We're basically going to derive conditions under which tilting is going to be more effective than exclusion. In other words, responsible investors should not divest an entire sector, okay? But rather you should hold the best as an class. I'm trying to convince now the University of Washington to do that. Let's see if that's going to be successful. But they are convinced, no, we should just divest from entire sector. Another way to say what I was just kind of arguing for is that maybe we should actually look at industry-adjusted ESG measures, right? Let's just not look at an absolute, but benchmark that with whatever the scores, the ESG scores in a given sector. And then we are able, with the analysis, to give a little bit more details about when tilting is going to be effective, or more effective than exclusion. It's not always the case that tilting will be the best strategies, and we can relate that, for example, to the sector in which you are. So maybe it makes sense to tilt in the energy sector because companies can take some measures to improve or to reduce their carbon emissions, but maybe in a controversial weapons industry, there isn't much you can do. Okay, there are no corrective actions, they're not very effective. It definitely depends on how sensitive managers are to the stock price because of reputational concerns, whatever. It depends on the quality of ESG disclosure. High quality will promote tilting. It depends a lot on the existence of some hedge funds who are just profit motivated and are able to pick up the stock that are being dumped by those responsible investors and by greenwashing concerns. So hopefully I'll be able to provide a little bit more intuitions about how those factors affect the effectiveness of tilting. Okay, so that's the agenda. Let me very quickly say something about the literature. I mean, maybe the most important thing I want to say is that there is now a recent paper, and I think most of you are familiar with, Ricardo Hart and ECGI as part of their agenda. They're arguing that engagement is actually more, I would say, superior to divestment. Voice is superior to exit when it comes to convincing companies or affecting companies' social policies. In our paper, there is no engagement. We're basically shutting it down. Well, there are many reasons for that, but we think it is important to look at divestment as being the most kind of common strategy as of now. And also in many ways in our analysis we're going to argue that divestment, usually we think about divestment, what's the cost of that? Well, if you're going to sell, you won't be able to stay and engage. In our case, the investment can actually be harmful simply by not giving the right incentives to managers to take corrective action. So it's kind of a different channel. Now, again, not that I want to really get into an argument with Nobel lecturate or anything like that, but in general, we think that the evidence for engagement, many people cite like the Exxon, the energy one, and Exxon classified as a great example of engagement, maybe, but I think that's kind of one exception. It really takes a lot of resources to prove what they did. And I think most companies, most asset management don't have those resources. Okay, so we're going to talk about divestment, not saying that engagement is not important, but okay, so let's talk about the model. That's the last session for today, so I figured it's going to be kind of sharp theory. Last session for today, so sharp theories can be a nice way to finish it up. No, I'm not going to get into any equations, very little. But I do want to kind of provide a framework. Okay, so think about a company that, we're going to have some long-term value, it's going to issue some shares in order to finance investment, which is going to generate some return. It's going to have some externalities, that's why it's brown, okay? It's always going to have some externalities. And importantly, managers can take some corrective action to actually reduce those externalities. Okay, and we're going to have different types of investors. We're going to have like household, maybe risk averse, car utility, very standard. and we're going to have this block holder, which is responsible, socially responsible investors. So they really care about minimizing externalities, and we're going to have a competitive market for shares. Share price will be just good. Okay, so it's a simple model, and here is how you can think about what we have here. So initially, the investor is going to announce what is their investment strategies. Okay, and they're going to commit to that. Basically, it's going to be how many shares I'm going to own or buy of this company as a function of the action, the corrective action they're taking. So for example, if I'm going to exclude, it means that no matter what the company is doing, I'm not going to buy any shares. So x of 0 will equal to x of 1 equal to 0. But if I'm going to tilt, then perhaps I'm going to buy some shares, but only if the company will take some corrective measures. Okay, so the block holders is initially announcing that and committing to that. Why? Because perhaps deviating from your divestment strategy is going to be costly in terms of outflows or in terms of maybe even some regulatory interventions. And we have some extension for non-commitment. If I have time, I'll talk about it. Okay, so first, the responsible investors is announcing what is going to be the divestment strategy, and then managers can take a corrective action. So in our mind, there's always a trade-off. Okay, if you're going to take a corrective action, that's going to be at the expense of the profitability of the firm. By how much? That's going to be C, that's the parameter. But it's going to reduce externalities. So F stands for externalities. When you take the corrective action, A1, that's going to be lower than if you don't take the corrective action, so lower externalities. And the action is public. Now, of course, I think that's a legitimate question. To what extent these ESG or social policy, environmental policies taken by firms are observable. So I have something to say about disclosures and the incentives. To what extent those incentives can be provided where we only observe some noisy signal of managers' actions. Okay. After this action are taken, then we have a primary market where the firms issue some shares, selling Q shares for a price P, which is determined in the equilibrium in the financial markets. And then whatever they raise, they can invest and earn a return of R. And then we're going to have the secondary market playing out, which would be a supply of 1 plus these Q shares and demand by the risk versus the domestic household and the responsible investors based on whatever the investment strategy that was announced. Okay? So first, investors is announcing the investment strategy, then managers taking or not taking corrective action. Then there is a primary and a secondary market, and finally, we're going to have some cash flow and externalities. I'm going to talk about some extension to having arbitrage laws. Okay, so here are just some details. Firm value is determined by asset in place, by investment, opportunities, and externalities. What is important about externalities is that the externalities increase when the firm expands, when the firm invests more. That's why buying shares in those companies which are going to potentially increase the share price is detrimental from the perspective of the responsible investors, because it will increase the externalities. And the corrective action, as you can see here, is going to reduce those. Okay, and this parameter, this whatever Greek letter it is actually measuring the effectiveness, how effective those corrective actions are. Okay. So what is the manager trying to solve here? The manager is simply maximizing some weighted average between the share price, the short-term share price, if you will, and the long-term firm value, which is denoted here by V. What the result will hold even if the manager completely, they don't care about the short-term stock price, but we think in practice there are many reasons why CEOs do care about it. It could be takeover threat, compensation, and so on. So we think that's kind of important. And of course, the manager has no social concerns, so otherwise we don't have an issue here. The investors are simply minimizing the amount of externalities, so they're choosing the investment strategy to minimize the externalities that the firm is going to exert. Again, we can think more generally about investors that are balancing between profitability and externalities, but we think it's a useful benchmark to think from the perspective of minimizing externalities what you should be doing. So that's going to be our at least baseline analysis, and households are just going to have a usual demand with current activities. Okay, now the details are not that crucial. Okay, so let me talk a little bit about the result, and then I can get to the core intuition. So we can solve for the financial market, and this is going to be the stock price that will emerge in the secondary market as a function of A, the action taken by, the corrective action taken by the manager, A can be equal 0 or 1. What is really important here, you can see the way in which those actions affect the stock price. On one hand, they are going to reduce the reducing firm value. That's kind of the basic trade-off. So firm profitability is going to be lower. That's the first term. But on the other hand, depending on the divestment strategies of the block holder, they can potentially increase the stock price because if the block holder is going to demand more shares, and we have an upward sloping demand curve, then that's going to increase the stock price. And that's really kind of the crucial point is that the action can affect the stock price through its effect on the block holder's divestment strategies. Okay, so with that in mind, we can talk about the manager's incentives to take the corrective action. And basically what the managers will do, they will think about, okay, what's going to be the stock price if I'm going to take the corrective action relative to what it might be if I'm not, okay? So what we show is that there is going to be a cutoff, delta x here, such that if the amount that the block holder is going to buy when the manager is taking a corrective action is relative to how much he's going to buy if a corrective action is not taken sufficiently large, right? In those cases, the managers will actually take the corrective action. Why? Because if the block holders will trade more, the stock price will be higher, and the manager cares about the stock price. Okay, so we can think about that as basically as kind of an incentive contract. What would be the optimal amounts, the X's, from the block holder's perspective? Well, if the manager is not going to take any corrective action and just buy no shares, why? Because this way we are minimizing, or we are maximizing the cost of capital, minimizing the stock price, and therefore the firm will invest relatively, will start the firm from capital based. Okay? So x of 0 always going to be 0, but x of 1, well, that depends. If you want the manager not to take the corrective action, if you are fine with that, then we're simply never going to invest in that firm. We're going to exclude it completely. Okay? But if we want the manager to take the corrective action, well, we're going to give him that incentives, meaning that we have to buy at least this delta x amount in order to put some positive price pressure on the stock price, so the managers will have incentives to take this action. And how much? The least amount of incentives that will induce the managers to take the corrective action. That will result with tilting, because we are buying shares in the company if and only if the manager is actually taking the corrective action. Okay, so this is what the block holder has to do to induce the corrective action. This is what he will do if they don't want the manager to take the corrective action. And now the only question that remains is under what circumstances the block holders would find optimal to induce managers to take the corrective action. Remember, the objective of the block holder is to minimize externalities. Okay? So we derive this cutoff. Basically, again, this parameter stands for how effective the corrective action are. So it's very intuitive. If they are relatively effective, it's above the threshold. You're going to induce that action, the corrective action, and it depends on a bunch of parameters. But what is kind of the key economics here? The key economics here is that exclusion reduces the share price, which limits investments and therefore externalities. Okay, that's really the benefit of exclusion. Whereas tilting is going to incentivize the manager to take the corrective actions, which directly reduce externalities. Okay, so the exclusion will operate exclusively through the primary markets by increasing the firm cost of capital, whereas tilting is going to operate through the secondary and the primary markets by basically giving rewards for managers for taking those actions. Okay, so the benefit of not excluding the company is that you're just providing incentives. The cost of providing incentives is that, well, the company will have a lower cost of capital, therefore they will invest more, which contribute for externalities. Okay, so again, in the paper, we can do all these comparative studies. Some are more intuitive than others. For example, if managers are more sensitive to the stock price than to the shorter stock price, then tilting is going to be more beneficial. Okay, so what I want to do next, I want to talk about some, we call it extension, but we think a really important kind of takeaway from this basic insight. So the first one is about the quality of the ESG disclosure. Right? So what happens if the block holders can only rely on the, you cannot directly observe what managers are doing, but there are some rating, like ESG rating, as we know there are, and they can condition their investment strategies on those ratings. Okay? So we model that by having some imperfect signal. And what we can show that, well, whenever the signal is noisier, whenever these ESG ratings are noisier, then it's going to be more costly to provide the managers with incentives to take the corrective actions. Because from the manager perspective, they understand they take the corrective action, but the market doesn't always observe it. So you really have to have a very large increase in the stock price in order to induce managers to take those corrective actions. What it means that the tilting is going to be relatively less effective as a strategy when ESG disclosures is low. So the analysis basically uncovers a new benefit of ESG disclosures. It's going to allow investors to better incentivize managers to take corrective action at a relatively lower cost. They don't have to provide so much capital to the firm in order to induce managers to take corrective actions. And I always want to remind you that in our model there is a trade-off, which means that if you are reducing externalities, negative externalities, it actually comes also at the expense of firm's profitability. So it depends a lot on how much weight you put on those externalities versus firm profitability. Okay, greenwashing concerns. Many investors, as also I think Marco was suggesting, but at least some, are also performing some of their own analysis about the social and environmental policies that firms are taking. So perhaps we can think about cases where the blockholders can actually engage in that analysis to acquire perhaps some private information. But we think it's realistic to think about those blockholders as having some reputational concerns. And basically, the concern they might have is that if they're going to generate this private information and they're going to condition the investment strategies of that private information, that might create some greenwashing accusations. Because they're going to buy some oil companies, which perhaps they rightly observe they have taken good measures to make a transition to renewable energies. But from the eyes of the market cannot really see that. Right? They're only making their decisions based on the ESG ratings, which are noisy. And if so, they might accuse that asset managers for basically investing in oil companies, even though they say that they are kind of social responsible fund. So if that concern, parameters by G, is large enough, then asset managers will actually have no incentive to acquire this private information. They will not do that. They will only rely on the public information, which ultimately will make it harder to incentivize managers to take those corrective action. So in other words, these concerns about greenwashing, the pressure from the market to behave as a socially responsible investors could become counterproductive, backfires, and actually make firms or prevents firms from adopting those corrective actions. Okay. Yes. So let me just say let me skip that and say one more thing, okay, about arbitrageur, because I think that's important. There is a common criticism of the investment that, well, if you're going to sell, someone else is going to pick it up. Therefore, the investment is not going to be very, very effective. So we have the model. We just introduced some arbitrageurs, some investors who can actually pick up those shares. And the intuition is that both exclusion and filtering are going to be less effective. But the subtle and I think an important insight is that the existence of those arbitrageurs is going to have a stronger effect on exclusions, which means that tilting is going to be relatively more effective when you have those hedge funds who can pick up those stocks. Why? Because when you tilt, you're buying shares of these companies, you're leaving less room for the hedge funds to actually make some gains from the trade. Okay, so let me just conclude. There is one kind of important takeaway here is that tilting can be more effective than exclusion. The cost of capital channels might be weak, but firms can still be incentivized to take some corrective measures. So responsible investors should not invest in the entire sector. They should hold the best asset in class. Let's kind of look at industry-adjusted ESG measures. This might help to prevent, greenwashing concerns, incentivize managers to take corrective actions, even facilitate disclosure. They talk about it, we have it in the paper, and ultimately have some real effect on action taken by firm. Okay, that's all. Thank you.
Thank you.